Well, in terms of global markets, the US markets continued their downward move, through this week. That has been the case, and pressure continues on markets. Before we go on to how US markets have done over the last 3 and 6 months, of course, quarter ended 30th June. Let's take a look at what happened in markets yesterday. So the Dow was down around 4/5% in trade yesterday. The S&P 500 was down around 0.9%, that's 9/10%, and the Nasdaq was the worst hit as usual, 1.32% lower in trade yesterday. But when I'm looking at it over the course of the quarter, the Dow is down 11.3% through this quarter, and that's quite a steep fall over a 3-month period. The S&P 500 though is down even more, 16% down for the quarter. That's the worst fall since COVID. And when I'm looking at it year to date, which is the first 2 quarters of calendar year 2022, the S&P 500 is down over 20%. That's the steepest first half fall that we have seen in the last 52 years. That is since 1970. And mind you, in 1970, when the S&P did fall 20+% or more than 20%, the rebound in the second half of the year was of more than 25%. So that's an important metric to look out for. But this time circumstances are different. Moving quickly on to the Nasdaq is down around 22.5% for the quarter, and that's the largest quarterly drop since 2008 and the largest first half yearly drop since 2002. So couple of metrics there that the Nasdaq has breached. Further, it is down over 30% from its all-time high, which it clocked in November of 2021. So clearly a lot of drag on markets at the moment. In terms of the Nasdaq, sticking to it, Netflix is down 71%. Apple and Alphabet have lost roughly 25%, and Facebook parent Meta has lost 52%, and that is just the frontline names. The broader markets are lower even more, so there's been a larger impact among the tech broader markets. So clearly some tailwind in markets at the moment, and that's led by 2 factors. One is of course the inflation numbers, which have steadily come in higher, and second is that interest rates continue to go up. Largely one would need to factor in as to how much of these interest rate hikes have already been factored in by markets, and really play the reversal if at all. That's probably where the alpha lies. Moving quickly on to Europe, European markets also saw cuts. They closed lower and they closed the quarter sharply lower as well. In fact, the stock 600 was down 1.6% on Thursday. And it's been the worst quarter for European indices since COVID. The first half has seen the stock 600 decline 17%. That's of course the broader European index metric which one looks at, and that's the worst first half since 2008. Moving quickly on to how Asia has opened. Asia has largely opened mixed, the way I'm looking at it. The Nikkei, the Shanghai and the Hang Seng are down, but the ASX is higher, and the Kospi, which was higher earlier in trade today, is now trading negative. So the Nikkei is down around 9/10%, the Shanghai is broadly flat, and the Hang Seng is down around 2/3% as we speak. The ASX 200 is up 1/3% against on the backdrop of the kind of global cues we are looking at. That's definitely a plus, and the Kospi is down around 0.5%. Where is the SGX Nifty? Broadly flat. It's around 10 basis points lower as we speak, around 1/10% down. Moving quickly on to commodities, oil has come off on the back of larger fears of a recession. So oil is at currently $106 a barrel. Brent is below the $110 a barrel mark. Moving quickly on to gold. Gold continues to remain under pressure as the dollar index has gained sharply. Dollar index above 104.5, and that means gold will continue to remain under pressure. Gold is at around $1,805 an ounce. Moving quickly on to bond yields. Bond yields have come off their highs. 3.2% was the high made on the 10-year bond, the US 10-year treasury, that's come off. It's below 3% at the moment. It had declined yesterday, it had come back up in early trade today, and now it's gone back below that 3% mark, and markets are lower despite this. So this is definitely something that one must keep in mind, but this is largely because bond prices are going higher, and that's largely because demand for bonds has gone up. There's a risk of trade at play. People want safer assets. Investors want to invest in safer assets. Moving lastly to crypto, of course, moving to safer assets and moving to crypto. So, crypto has taken a beating in recent months. In fact, currently, or rather earlier yesterday, Bitcoin went below the $19,000 mark. It's recovered a bit after that. It's come back above the $20,000 mark as we speak. Largely, we are seeing negative cues even for Indian markets, but it's a more composed negative that we are looking at the moment.